In today's show, I'm talking about year-end and tax strategy planning, putting yourself in the best position possible before the end of the year to help maximize your retirement and minimize your overall tax burden. We're talking about maximizing your retirement plans, whether at work or outside of work, spousal IRAs, Roth Conversions, and if you're age 72 plus and you're taking required minimum distributions, I'm going to talk about ways to potentially save on the tax on those RMDs before the end of the year. Also, I talk about the number one most overlooked tax advantaged account. Stick around.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and of course, we're going to talk about potential ways to help reduce your taxes. I'm your host, Scott Searins, also president and financial advisor at Searins Financial Group, and we have an exciting season upon us. Yes, it's football season, but I'm not talking about that. I know for some of you, it's pumpkin spice latte season. However, I'm not talking about that either. Actually, I've never drank coffee. I tried it once in 5th grade, and ever since, haven't even tried it again. But folks, it is year-end planning and tax strategy season. You might be thinking, wow, how does Scott consider this exciting? But to me, it's exciting because here's the deal. I want to pay the IRS only what I legally have to, but I don't want to leave them a tip. And so whether it's my money or whether it's our client's money, that's our goal. Pay what we legally have to, reduce what we legally have to pay, but not leave them a tip. On top of that, there's some great things that we can do before year end to help improve our retirement picture, help improve our tax picture. So yes, I actually consider this a season. Actually, in October, all of our clients are coming in to sit down to go through a year-end planning and tax strategy meeting together. We've got a 20-point plus checklist that we're going to go through to help put them in the best position possible by the end of the year. And so what I thought I'd do on today's show is grab a few points from that checklist. Today will be part 1, and then we'll also have a part 2. Now I'm going to talk about a lot of strategies today. We're going to talk about maximizing your retirement plans, which accounts are the best to put your money in, how to get the most from it. We're going to talk about what to do if one spouse is working and one spouse is not working, already retired, or just not working. We're going to talk about Roth Conversions. I'm going to dive into the number one overlooked, most tax-advantaged account. And then if you're age 72 plus and you're taking required minimum distributions, we're also going to talk about how to save on these RMDs, required minimum distributions. And the reason I consider this a season is because a lot of these strategies have to be implemented before the end of the year. A lot of times we think about tax season and taxes that we don't have to submit our taxes until April 15th, right? For 2022, we don't have to submit our taxes until next April in 2023. But a lot of these strategies need to be actually implemented before December 31st. So lots of strategies. All of them, of course, are going to depend on your unique situation. So consult with your tax advisor, consult with your financial advisor. If you don't have one, you're not sure who to go to, you can always go to lifemoneyshow.com, click on the Work With Us tab. We can have a 15-minute phone call and determine if we're a good fit to partner together, or I'll always point you in the right direction in regards to your overall situation. And before we dive in, if you haven't yet, which aligns with today, a great guide for you when we talk about paying what we only legally have to and not leaving the IRS a tip. If you haven't yet, download our tax strategy guide. Go to lifemoneyshow.com/taxes. Again, that's lifemoneyshow.com/taxes. There's a guide there that's going to help provide you tax reduction strategies. And utilizing that guide, what it means is that, again, helping you pay what you legally have to the IRS, reducing what you legally have to pay, but not leaving them a tip. We want to tip our waiters, we want to tip our servers, we want to tip those that help us out, but we don't want to leave the IRS a tip. therefore increasing your overall wealth. So with that, let's get started. I'm picking a few off the list here from our 20-plus point checklist of year-end planning and tax strategy items. And the first one is maximizing your retirement plans. And I've got a few sub-points under this one. So we're going to talk about maximizing your retirement plans. And before I get into some of the other points, one of the biggest questions I get is, which accounts should I put my money into? So let's just first start, whether you've got a 401k, 403b, 457, or maybe you just have IRAs and Roth IRAs. Let's talk about optimizing the mix. Optimizing the mix, what does that mean? Well, you might have traditional type tax deferred accounts available to you. What's that mean? A 401k, 403b, 457, IRA. Those accounts, you get that tax deduction today. So you put money in, say you're making $100,000, you put $20,000 into this tax deferred account, you're actually going to get the tax deduction today. So your $100,000 income goes down to $80,000. All of the growth is tax deferred, but remember, you will pay taxes on those accounts in the future, and those are the accounts that also require you to take those distributions at age 72. That's that forced income the government forces you to take out, so you will pay tax on the future. Now, there's also a different type of accounts, the tax-free accounts. But when I say tax-free, it's tax-free for the future. You actually have to pay tax today. What are those? Those would be your Roth 401k, Roth 403b, Roth 457, your Roth IRA, where you will pay tax today on the money, get it into the account, but then the money grows tax-free, and all of your withdrawals in the future from the base that you put in, plus any growth, all of those future withdrawals come out to you tax-free as well. So first off, looking at your retirement plans that you have at work or that you have outside of work, and do you have the traditional 401k available to you? Do you have the Roth 401k available to you? Do you have a Roth 457 or 403b available to you? What do you have available to you? And then how do we determine how to optimize the mix? Which one do we choose to put our money in? Well, that depends on what your taxable income today is versus what your taxable income will be, or what you project your taxable income to be in the future. Let me just walk you through an example. Let's say you're a married couple filing jointly, and today you're making $350,000 a year. That puts you in the 32% tax bracket. Now, if that same couple projects out their future, and in the future, in their retirement, the income that they'll have coming in between Social Securities, pensions, required distributions is only going to be $200,000 a year. Well, then in the future, at today's brackets, right, they would be in the 24% tax bracket. So for them, it might make more sense to use the traditional 401ks, traditional 403bs, IRAs, etc. Why? Because they want to get that tax deduction today. They want to put that money aside. Rather than pay 32% on it today, they want to put it aside, let it grow, and pay at that potential lower rate in the future using those traditional tax-deferred accounts. Now, let's go through another example. Let's just say you're married filing jointly. You're making $100,000 a year. That would put you today in around the 22% tax bracket. But let's just say in retirement, you have Social Security coming in, your pension coming in, and based on what you've saved up, you've got those required distributions coming in, and now in the future, you're making $150,000. In your retirement, you've actually got more coming in than you did today. Or let's just say $150,000 a year coming in. Well, that's the 22% tax bracket. So you'd say, hey, well, it doesn't matter. I could choose the tax deferred account or the Roth type account. It's the same percentage either way. But one thing that you need to think about is the Tax Cuts and Jobs Act, which expires at the end of 2025. So if Congress lets this expire at the end of 2025, the 22% bracket becomes 25%. The 24% bracket becomes 28%. So next thing you know, let's just say you were using the regular 401k, you're actually pushing your money to a later date where you're going to get it taxed at a higher rate. So this is where it all comes in. Where do you feel? So in that scenario, right, in the scenario for this example, it would make more sense for that couple to put their money into the Roth 401k, Roth 403b, Roth IRA. And a lot of people, and I've done a lot of workshops and working with people here, a lot of times we think that our taxes will be lower in our retirement because we're retired and we're not having our employment income coming in anymore. However, if you've saved $1 million, $2 million, $3 million, $4 million, $5 million or more in a 401k or an IRA, 403b, or any sort of tax-deferred account, you have to start thinking about those required minimum distributions, that forced income that the government's going to make you take out starting at age 72. And when you start projecting that out, I've found for some folks, it can actually put them with a higher taxable income in their future, just like my last example here, right? They might have $200,000 of income coming in their future because of these forced distributions versus where they were at prior to retirement. So when they're putting all that money away tax deferred, they were actually putting it away. Then the government's going to force them to take it out. And based on how much they're forcing you to take out, next thing you know, your taxable income is in the future is higher than where it's at today. Tax meaning your tax rate in the future could be higher than where it's today, and you're paying more tax on that money versus what you would have paid today. So here's my personal opinion. For those that are in the 30+% tax brackets, it might not make a whole lot of sense to use the Roth 401ks and 403bs. However, for those under the 30% tax brackets and that have saved $1 million or more, I'm a big fan of the Roth. But as I mentioned earlier, everybody's situation is unique. And the number one thing to do here to determine and optimize your mix is to do a future projection. Project out not only how much Social Security you'll have coming in, rental income, pension income coming in, but also project out what those required minimum distributions are going to look like. Not only in your early 70s, they start at age 72, but what could that look like at age 85, age 90? Because over time, the amount that the government forces you to take out grows and grows. Okay, so let's just wrap up. The first part of retirement plans is optimizing the mix, looking at your account. Do you have a Roth 401k? Do you have the regular 401k? Go through the thought process of where your taxable income will be in the future versus where it's at today. Don't forget about those forced required distributions that are required from 401ks, 403bs, IRAs. Taking a look at all of that, then optimizing where you should actually put your money. Just a short example here, we recently worked with a couple based on what they had saved up. Even though they're 5 years away from retirement, they have most of their money already saved in 401ks. Based on that, they're going to look at high required distributions in the future. We've switched them over based on their unique scenario to Roth 401ks as it makes more sense for them right now based on how much they're making. All right, how else can we maximize our retirement plans before the end of the year? Well, first off, if you're not contributing to one, you should start. Start contributing to your 401k, 403b, or the Roth versions of those accounts. Get started. You need to start. If you have started, make sure that you're getting the company match. If your company is going to match up to 2% or 3% or 6% or 10%, make sure you're putting in enough so that you're getting the company match. And usually that's on an annual basis. So if you haven't been doing that, take a look at your accounts, up your percentage if you need to before the end of the year here to make sure that you've fully got the company match. All right, keeping with the retirement plan theme here, what else can we do? You can maximize your plan. The limits in 2022 for contributions to a 401k is $20,500. And if you are age 50 and over, you can actually contribute $27,000 to your retirement accounts. Maximize your retirement plans if you have that ability to. Because with the regular IRA or the Roth IRA, you can only put in $6,000, and for those age 50 plus, again in 2022, $7,000 a year. But using your company plan, you can put in way more and without income limits. Why do I talk about that? I'll talk about that here in a second when we talk about IRAs and Roth IRAs. So here's the other point on maxing out your company plans. You have to make sure it's maxed out. Now, I know a lot of companies and providers, they've done a much better job at improving their systems. But one thing that you have to take a look at is making sure that if it allows you to put in $27,000, did you get all $27,000 in? Because sometimes if you're putting in so much, they'll try to shut it off early on. They won't let you get the whole amount in there. And you got to make sure, not that they won't let you, but based on your contribution amounts, they might just kind of tailor it down. So make sure you get the maximum amount in there that you can. The other part there is think about increasing it for next year. If you can save more, if you're maybe you're getting a bonus, maybe something you're getting an increase. If you have that ability to save more, take the time to do it and set yourself up for that automatic increase. Do it now. Don't wait till next year to say, I'll just kind of see how things are going. Push yourself to save that 1% more, that 2% more, that 3% more into your retirement accounts. Your future self will definitely thank you for doing it. Now, continuing down the theme of maximizing your retirement accounts, a lot of what I just talked about there was maximizing your company-sponsored retirement plans. But let's just say you've maximized those out. You've put in the full amount that you possibly can. Or you don't have a company plan, but you do have earned income. Well, the other thing that you can look at is funding an IRA or a Roth IRA. As I had mentioned earlier, just the limits are a little bit lower on these accounts. But again, it still allows you to take money and get it into tax-deferred growth, or take money and get it into that tax-free growth in the Roths. Now, just to be aware, IRAs, Roth IRAs, there are income limits. So you want to talk again with your financial advisor, your tax advisor, to make sure that you can contribute to the IRA, because last thing you want to do is put too much in or just put it in when you weren't able to and then have to work through the process of taking it out. So do what you can to maximize any different type of account that you can. Again, your future self will thank you for the job that you've done. Now, I realize I've talked a lot about maximizing company-sponsored retirement plans or just your individual retirement accounts or your individual Roth IRA account. However, one thing that I do want to bring up, and this is just kind of maximizing your savings overall, and also just want to talk about tax diversification, is you may want to add in a brokerage account. Now, this is considered a taxable account, so you're not getting that tax-deferred growth or that tax-free growth. However, this type of account, you can invest in a brokerage account. You can put your money into investments in the brokerage account. And what it provides to you is flexibility. It provides to you flexibility to be able to withdraw from this account prior to age 59 and a half. Why is that such a key date? Well, because the 401ks, IRAs, 403bs, and the Roth versions of all those, you're not able to make withdrawals from those accounts until age 59 and a half. If you do prior to that, then you might have to pay an early withdrawal penalty. So this is something that I do myself in my overall plan. I diversify where and what tax buckets I'm saving into. I use a brokerage account as well. And the reason being is just because of what I just talked about. I am looking for that flexibility. If I need to make a large purchase in the future, whether it be a down payment for a home, maybe it's a new car, whatever it might be, if I need to go and take from my 401k or 403b, it could potentially push me up into another tax bracket. But having the flexibility of this brokerage account, I can now go, I've got an account that's been growing with investments, but I can go and make withdrawals prior to age 59 and a half. And also it gives me other flexibility to take money out and potentially not put myself in a new tax bracket when I do. So wanted to throw that in there. But with that, that's maximizing our retirement accounts. Let's move on. Next, we're going to talk about the spousal IRAs and spousal Roth IRAs. So let's just say you're a married couple filing jointly, and one spouse is working and one spouse is not. Maybe that spouse has decided not to work. Maybe that spouse has already retired. Here is an overlooked strategy, one that's often forgotten, and it's the spousal IRA contributions or spousal Roth IRA contributions. So again, maybe one person's retired, maybe one person's working, but the other, or not working, but the other person still is, and you're just wondering, how can I get more money into my Roth IRA to grow tax-free, or my regular IRA to grow tax-deferred? Well, as long as one spouse has earned income, you can actually make contributions to the IRA or to the Roth IRA of the non-working spouse. So you can get more money into that tax-free account or that tax-deferred account. Now, the deadline for this is April 15th, but hey, it's another thing. If it's on your mind, you're thinking about it, just get it done. Get it in there. Get it saved. The one thing to think about this too, and a question that I always see is, well, Scott, I don't really see how that fits into my current cash flow. However, that person might have $50,000 or $100,000 or a bunch of money just sitting in their checking or savings account. Well, this is a great opportunity to take some of that lazy money and take a certain amount of it and just transfer it into that spouse's IRA or Roth IRA. Now, just like the regular IRAs and Roth IRAs, there are income limits, meaning if you make over a certain amount of income, then you may not be able to contribute to your spousal IRA or to your spousal Roth IRA. So make sure you look at the IRS guidelines on that. But this is why I say it's very overlooked, because I see people sitting on cash. That cash is generating interest. That interest gets added to your taxable income when you can just take then, again, as long as one person's got income coming in, you can just take and shift some of that cash over maybe to their Roth IRA. Now, instead of generating taxable income, it's growing tax-free. Just a thought process, different way to look at things. It's something that we do when we're sitting down with all of our clients and going through, looking at their overall situations, looking for unique strategies, again, to help keep more in their pocket versus giving it to the IRS. All right, moving forward. Now, sticking on the retirement front, one of the most overlooked, one of the most tax advantage plans out there, the health savings account, or sometimes called HSA. If you're in a high deductible health plan, you might have the ability to contribute to an HSA either at your work, or if you're self-employed using a high deductible health plan, you might be able to contribute to an HSA as well. Why do I say this is the most overlooked, most tax advantage plan out there? Well, when you put money in, you get a tax deduction. So you're making $100,000, you put $6,000 in, now your taxable income is down to $94,000, saving money there. The account can be invested, and then it grows tax-free. And here's the triple tax advantage part of it. You can make your withdrawals from this account tax-free as long as you're using it for qualified medical expenses. So let's just go through this. You save into the HSA. You invest it. You let it grow tax-free. Then in your future, right, you can utilize it to pay for Medicare tax-free. You can utilize it to pay for your long-term care tax-free. You can use it to pay for doctors' copays, for your prescriptions. You can use all of this money tax-free in your future. So picture this. You're retired. You have a health bill come in. You do not have an HSA. You have to go and pull money from your IRA. Not only are you paying for that health, you have to pay tax on the money that you're pulling from your IRA to pay for the health bill. Instead, let's say you did utilize the HSA. Now you're retired. You've got the HSA. You get that same health bill. You pay that health bill from your HSA, pay the bill, no tax. Sounds like a better picture to me. Again, you got to check with your employer, your plan, your health plan, and see if you can incorporate the HSA into your overall plan. Just a quick story for you here. We have a client that is in their mid-50s, and they have the HSA available. And one of the things that we're doing is we're having them contribute to their HSA and investing that money. And if they have any health needs that come up, unless they're something major, but even just the small things that come up right now, they're paying that out of their own pocket versus taking it from the HSA. I think, wait a second, isn't that kind of backwards? I thought the HSA was to pay for the health. And you're correct. However, what we're doing with them is we're just letting that HSA grow and grow and grow, so that way once they retire, they've got this nice healthy pot of money in their HSA that they can make tax-free withdrawals from to pay for their Medicare, to pay for their doctor's bills. So right now they've got income coming in. Since they have income coming in, the minor health bills that they do have coming in aren't really stressing out their situation. And it allows them to let this money take advantage of the triple tax advantaged account and just let it grow for later. And then, like I say, they could use it to pay for their Medicare in their future, all tax-free. So HSA, very overlooked account. If you have one, you may wish to take advantage of it. Here we go. Next on the list, now venturing away from those company-sponsored retirement plans, next on the list is Roth Conversions. Now this one is important to pay attention to before the end of the year because Roth Conversions have a December 31st deadline. And I'll tell you what, a lot of the institutions now are implementing that any sort of Roth conversions typically have to be done before December 15th or December 1st. A lot of institutions aren't going to let you wait until December 31st to make your decision. So, folks, this is something that if we're going to implement this strategy with all of our clients, we're getting this done in November because we know in December, most likely, the institutions are going to be packed with year-end requests. And if you want to make sure it gets done, do it in November because it could be possible that you won't get it done if you wait till December. What is a Roth conversion? And again, like all of them, check with your tax advisor as well as your financial advisor. But a Roth conversion is paying tax today. So taking money out of your 401k, taking money out of your IRA, taking money out of your 403b or 457, paying the tax on that money today and shifting it over into the Roth account where then it will grow tax-free and you can make withdrawals from it tax-free. As I mentioned, though, you have to pay the tax today. We take a very strategic approach at this, meaning we're not just taking all of the money out of the IRA or the 401k or 403b to do this. You want to look at your long-term tax projection. Where does things project out to, like, which bracket might you be in? Based on that, you want to use that to say, okay, should you even do a Roth conversion? Because for some people, it really doesn't make sense to do a Roth conversion. Your taxes might be lower in retirement. But if you're worried that, you've saved up $1 million, $2 million, $3 million or more, if you start thinking about the forced income that you'll have to take out at age 72, and if you're just worried about taxes being higher in the future than they are today because of our gobs of national debt, well, then maybe you want to consider a Roth conversion. And when I say a strategic approach, you're looking at your tax brackets to maximize different tax brackets when you do the Roth conversion, meaning maybe going up to or filling up a certain tax bracket, but not spilling over into the next one. Again, this is something that you really want to make sure that you're projecting out your future income and then also projecting out your current income, looking at what your income will be by the end of this year understanding which tax brackets you might fall into, and then converting an amount that may be appropriate for you. A few very important points to understand when doing this. You have to also take a look at, could this impact your Medicare? Because if your income goes over a certain amount, you might be then looking at the Medicare premiums because of having a higher income. So take a look at that. Could it impact the taxes on your Social Security? So it's not just, hey, do a Roth conversion and fill up the tax bracket. You want to look at all the other things that it could impact as well. This is something that we do when working with our clients, is we go through our tax projection software, and it tells us all of the different limits that clients are approaching, and if they go over certain amounts, what that could mean from an impact standpoint. Plus, we then sit down or talk with their tax advisor to do some final projections and then determine the amount that would be right for them, if any, to convert by the end of the year. Another good thing to think about right now when it comes to Roth conversions is it might be a good time to do so because of overall market conditions. What do I mean by that? Well, picture this. Picture having a spring just sitting in the palm of your hand. Now, if you take your other hand and compress that spring down, that's where the market is today. Your accounts right now are probably compressed. Okay? So now could be a good time to pay that tax today while the market's compressed. Take that spring or parts of that spring, shift it over into the Roth account, and then just like we've seen over history where the market rebounds and does better over time, that's kind of like letting your hand off that spring. So you've paid taxes while the account value is lower. You've shifted that spring over into the Roth bucket. You let your hand off that spring, and it's bouncing back with growth. But now it's bouncing back with growth in that tax-free account versus that tax-deferred account. So just another thought process there when it comes to Roth conversions. Okay, our final point today, and then like I said, we're going to have a part 2. I'm just grabbing some different items from our year-end planning and tax strategy checklist that we utilize with all of our clients. And our final point today is looking at qualified charitable distributions. This is a way to potentially save on the tax of your required minimum distribution. So if you're age 72 or higher, and you're taking your required distributions from a 401k, or let's just say from your IRA, again, at age 72, you're forced to take that money out, and all of that money from a traditional 401k, 403b, 457, or IRA, that money is going to get taxed. So a way to not pay taxes on all of your required distributions would be to give it to, and if you're charitably inclined, would be to give it directly to a charity. So you might be thinking, hey, Scott, I already give to a charity now. I don't get any tax benefits from doing so because the standard deduction that I get is so high. Well, there's a different way to do things. Instead of giving from your checking and savings or taking money out of your IRA and then writing the check over to the charity, if you're to give directly from your IRA straight to the charitable organization, it can help reduce your taxable income. Let me just walk through an example of how you could potentially utilize this to benefit your situation. Again, assuming that you're age 72 plus and you're taking those required minimum distributions at forced income from your IRA. So let's say you've got $50,000 of income coming in. You have to take a $50,000 required distribution. Let's say you bring all of that money to your bank and you are charitably inclined. Let's say you're writing, on average throughout the year, $10,000 worth of support to different charitable organizations. Well, in that situation, since you brought that IRA distribution to your bank and then are writing the checks out, whether that be to your church or to a favorite organization, you still have $100,000 of taxable income in that situation. $100,000 of income will get taxed. Now, the alternative way to think about this, that $50,000 of income coming in, can't change that. However, let's just say instead of bringing all of that money to the bank first, you decide which charitable contributions you're going to make. And you make those charitable contributions, that $10,000 of charitable contributions, directly to the charities from your IRA. That leaves then only $40,000 of required minimum distributions that you need to take. So, since you made those directly from the IRA, you've got $50,000 of income, $10,000 from your IRA went directly to the charities, meaning only $40,000 had to come out to your bank. Now you're looking at $90,000 of taxable income because you gave it directly from your IRA versus bringing it to your bank and then writing it out to the charity. Folks, there are ways out there to save hundreds and potentially thousands of dollars when it comes to your taxes. And it's just knowing and implementing the right strategies to put yourself in the best position possible. I've hoped that you've enjoyed part 1 of our 2-part series. Again, year-end planning and tax strategies, helping keep more of your hard-earned retirement income in your pocket versus giving it to the IRS. Retirement planning strategies to maximize your future wealth and your future growth. Coming in part 2, we're going to talk about charitable gifting and planning, education planning, as well as gifting, whether that be to your family, friends, or somebody that's just important to you. As you can see, there are a lot of strategies out there to help maximize your retirement plan and also minimize your overall taxes. Go to lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes, where you can get your guide of different tax reduction strategies to help you pay only what you legally have to and potentially reduce what you legally have to pay to the IRS and not leave them an excessive tip, all helping to increase your overall wealth. I hope you enjoyed today's show. If so, subscribe on your favorite podcast player, and I look forward to our next conversation to continue to help you maximize your life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.